person who has been prudent in his or her life and bought 2 or 3 or 4 pieces of modestly leveraged rental real estate has an inflation hedge. If their rents are sufficient to service the mortgage, and if their rents are fair in the context of the market that they operate in, inflation will raise the price of the construction of competing assets at the same time that competitors' cost of capital will go up. So people who have structured inflation hedges into their life, their own business where they have some pricing power, some moderately leveraged but high quality real estate, need to own less, as an example, physical precious metals. I will say too that too many people who buy our narrative overinvest in precious metals. They invest so much of their net worth in precious metals that they can't stand the periodic price declines that occur in precious metals.
In today's news recap, the current surge in gold prices has been driven primarily by investment demand. Amid the recent rally in the market prices, investors are increasingly adding gold to their portfolios. This tendency is most likely the result of increased geopolitical tensions and ongoing conflicts around the world. Furthermore, expectations of Federal Reserve Fed rate cuts has helped the gold market, as a lower fixed rate income would mean good news for gold investors. The most recent U.S. personal consumption expenditures PCE price index data reaffirmed these rate cuts expectations. It, along with the gold market's existing positive consolidation period, suggests that gold prices will follow the path of least resistance to the upside. Still, the demand for gold is affected by more than just the currently prevailing macroeconomic conditions. Figures published on this Sunday revealed that China's manufacturing activity has increased for the first time in the past 6 months. This favorable news has improved investor confidence, reinforcing the current risk-on conditions. Given such positive factors, the gold market is not without risks. The Relative Strength Index, RSI, on the daily chart is currently showing overbought circumstances. This could lead to some short-term consolidation or a slight pullback. But overall, the gold market in 2024 does seem positive. Now we'll show you more clips, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
But the fact is, I own lots relative to what I might need. Other people are less fortunate. Most of the American public, if pressed, probably couldn't spell gold. And I think they need to begin the process of systematic acquisition of gold, unless they have some other internal inflation hedge that works for them. In fact, with regards to my own circumstance, a good financial planner would look at my estate, being the largest shareholder of Sprott, and say, why do you own gold at all? If the gold price does well, the businesses that you own will prosper, and you'll win by proxy. I own gold because it's insurance. It helps me sleep nights and stay calm. Sleep is a good attribute if you're 71 years of age. So everybody's circumstance is different. For people who have their lives structured in a way that persistent inflation will be ugly for them, people with long bond portfolios, people relying on conventional pensions, particularly defined benefit pensions, I think they need to begin the process of the systematic acquisition of assets that are traditional inflation hedges, and they need to do it now. If the price of those assets falls, God bless. If I'm wrong, then your conventional pension will do a good job for you. But I would ask those people to consider the probabilities of what I've said. And judge their actions accordingly. I have found myself, if you look at the whole of my net worth, the whole of my portfolio, I've found myself adding cash. It is not a deliberate strategy. I'm not trying to get liquid. I am already too liquid. What's happening is that some of my speculative bets and some of my investments have paid off. They've gotten to the point where they're no longer cheap, so I sell them, and I haven't been able to redeploy the money. It was interesting. I'm not trying to liken myself to Warren Buffett, but I listened to Buffett's discussion the other day about the cash holdings of Berkshire Hathaway exceeding $300 billion. And what he said is, I'm finding myself opportunity constrained. He isn't suggesting that the market's going to collapse. He is suggesting that when he looks to buy businesses in the size and of the quality that attracts him, that there aren't very many opportunities. At the same time, some of the existing businesses that he owns in a large measure, Apple as an example, Bank of America as an example, are at this price, relative to the earnings stream he sees them generating over the next 5 to 10 years, less attractive. He hasn't been a seller from a strategic point of view. He's been a seller from a tactical point of view. And I find myself in the same circumstance, albeit, sadly, with a couple zeros missing.
On the technical analysis side, silver price shows negative trades to move away and support the chances of continuing the expected bearish trend on the intraday basis. And the way is open to achieve the next target at $30.63, which represents 50% Fibonacci correction level for the rise from $26.41 to $34.85. Thus, breaking it will push the price to suffer additional losses that reach $29.64. Holding below $31.63 represents the first protection factor to the suggested negative scenario, as breaching it will lead the price to achieve intraday gains and test $32.86 before any new attempt to decline. Let's get back into the episode.
Every precious metals bull market of my life, the bull market has been led by the metal, gold specifically. And I suspect that for most investors, that is the way that they should organize their lives. The purchase of physical gold is really the purchase of insurance. And it's important that people buy insurance before they even invest. It's important that to the extent that it's possible, that you have an asset that will help your family sustain its lifestyle in bad circumstances, and that's physical gold. In a normal bull market, after the gold price has moved, to the extent that it's moved enough that producing companies generate increased profits. Because remember, when the gold price moves, often the price of inputs around mining it increase too. So that the margin increase that you would expect to see often doesn't occur for 3 or 4 quarters. And that's precisely what we've seen. But this year has seen a real lift in the prices of ultra high quality gold stocks. Agnico Eagle almost up 50%, Wheaton Precious up 45%. Even Franco-Nevada, the highest quality of all gold companies, despite the fact that they lost 15% of their asset base with the nationalization of Cobre Panama, is up substantially. If past is prologue, the momentum that we've seen established both in the metal and in the senior gold shares will begin to embolden investors, and they'll look at valuation discrepancies between the biggest and the best and the second tier, and they will move down market. If they don't move down market, the great big companies will enjoy higher share prices and lower cost of capital, and they'll take over the second tier companies. And after the second tier companies, the market will go to a riskier asset class, which is to say the single asset producers. And again, some investors will look at valuation discrepancies. Others will look at potential M&A, and that sector will benefit, and so on, and so on, and so on. Finally, assuming that the market has legs, and I think this one does, that move will come down to the penny dreadfuls. And when you see the no account penny dreadfuls, the ones with $10 million market caps but no net present value, double and triple, it's time to begin to look for an asset class that's more out of favor. You need to remember that we reach certain periods of time where even in a good sector, even if you are a practiced investor or speculator, there's not much value left in the sector. That's what Warren Buffett is saying about the New York Stock Exchange. So it's important that people understand that. I believe that there is substantial value left in the gold equity sector. I believe, though, that for investors who aren't willing to do the work, naked commercial, for people who aren't willing to sit through the rule classroom, as an example, that people confine their investment in gold miners to the very, very, very highest quality companies. What you learn is in a real gold bull market, simple market beta, which I would define as the outperformance of the sector relative to the broad market, is so substantial that you'll get doubles or triples taking almost no operating and company risk. Now, if you're comparing that with a 10-bagger, which you might get with taking a lot of risk, that appears unattractive. But if you look at it in isolation, the idea of a low-risk double or triple over 5 years with handsome dividends while you wait, and by the way, with the probability of that outcome, as opposed to the possibility of a tenfold move in a lower quality company, for most people who aren't willing to do the work and can't afford psychologically or financially to take risk, they should, at least in this point in time in the market, confine their investments to the very, very, very highest quality gold equities.
So what did you think of Rick's approach? He shared his personal perspective on gold investments, explaining just how much he holds and why he believes balance is key. Are you comfortable with your exposure, or do his insights make you think twice? Let us know in the comments. And if you haven't already, hit subscribe for more expert advice on navigating the precious metals market. Thanks for watching, and we'll see you in the next video.